Subscribe to our YouTube channel and press the bell icon to get the latest updates.
2021 turned out to be the year of optimism and euphoria in the stock markets. IPOs were the best indicator of this, not just here in India, but also the US stock markets. Expectations ran so high that investors did not mind paying over 1600 times earnings for beauty and fashion company Nykaa during its IPO. Similarly, US EV maker Rivian fetched price to sales multiple of 2169 times during its IPO. To put it in context, this multiple was 100 times that of Tesla's price to sales multiple, which is about 23x. And legacy automakers have a price to sales multiple of just over 1 time. So you can imagine the kind of euphoria-led buying that has been witnessed in global stock markets. But just as everyone was getting comfortable with the idea of a new normal that is living in vaccine-protected world, Omicron, which is yet another mutated coronavirus, threatens to bring things to a grinding halt. Stock markets world over have been jittery over the past few days, and there's a possibility of more negative news derailing the COVID recovery joyride. Hospitality, travel, and consumption stocks were, of course, the first casualties of the Omicron fear. But if you thought that stock markets will soon take this new fear in its stride and glide through 2022, you could be wrong. Rather, some amount of preparation for a stock market pandemic in 2022 could prove to be very profitable in the difficult months ahead. Hi, I'm Tanushree Banerjee, editor of Equity Master's Blue Chip Recommendation Service, Stock Select. Welcome to Safe Stocks, where we discuss ideas to create and preserve wealth in the safest stocks. If you haven't subscribed to Equity Master's YouTube channel yet, please do so and click on the bell icon to get notifications for my latest videos. So coming to the possibility of a stock market pandemic in 2022. There are several data points that point in that direction. First, let's look at the most common data point, that is the price to earnings multiple, both historical, which is the 3-year average, and the current one for large, mid, and small cap stocks. What you observe here is that the segment of the market that has seen the maximum re-rating is the mid-cap category. Now, there could be two reasons for this. Either the mid-caps have actually fared better than their large and small peers, or companies in the mid-cap space just rode the market rally without any meaningful change in fundamentals. In other words, the maximum froth in valuations is in the mid-cap space. How do we confirm this? We need to look at the average return on equity of stocks in each of these categories over the past 3 years and their most recent shareholder returns. A comparison of the shareholder returns tells us if the profitability profile of the companies has improved. Now it turns out that the segment of the market that has seen the biggest re-rating has also been the worst performer in terms of return on equity. Mid-caps have actually seen their return on equity decline from the 3-year average. This means the segment remains most susceptible to a market crash. To understand this better, let us look at this flowchart offered by Professor Ashwath Damodaran, which very clearly explains the gap that leads to market crashes. So while on one hand we have the intrinsic value of the business, on the other we have the market price. Both intrinsic value and the price have their own determinants as is shown in the chart. Now when any of these determinants is disproportionately disturbed, be it say liquidity or market mood, the gap between the stock's value and price increases. To put it another way, stock prices are driven by investor sentiments. Meanwhile, companies' intrinsic value is a product of future cash flows. So when investors become euphoric, intrinsic value and share price converge. The gap closes, eliminating what we call the margin of safety. What happens then? Well, the share price starts to resemble the highest price that the business would command, and in turn, the stock's potential upside becomes negligible. In my view, the vast majority of stocks today fit into this group. Of course, there is very little certainty about when and how will the stock market pandemic strike, but we do know that it's only a matter of time before investors realize their flaws. Also remember, the transition from a small correction to a market crash to a bear market may be without warning. So yet again, investors may find themselves unprepared when markets throw them such surprises. Now here are some steps that you could follow to prepare and avert any negative surprises in the stock markets in 2022. First, practice second order thinking. What is second order thinking? It's tempting to give in to good outcomes with small upsides that are easily visible to us. For instance, we intuitively get attracted to buying stocks that are best performers in recent quarters, or companies that have been winning big orders or attracting big investments through an IPO. But are they truly your best bets? Second order thinking is a necessity to think beyond what we know. We must focus on things we haven't thought about by trying to join the dots. For instance, think about whether the margins are here to stay, whether the business moat has expanded, does the newly listed company have good corporate governance, etc. Second step is to invest in businesses that support innovation. It could be directly or indirectly by buying stakes in innovative startups. Of course, such stocks cannot offer near-term payoffs, but a long-term orientation subdues our enthusiasm for shortcuts. So buy innovative businesses with real moat that can help the stocks sail through difficult markets. Back in 2001, when legendary investor Howard Marks was asked how he prepared for a market crash, he replied, "You can't predict, you can prepare." No one knew when the US tech bubble would burst. No one knew what the extent of the correction could be or how long it could last. But it wasn't impossible to get a sense that the market was euphoric and investors were behaving in an unquestioning, giddy manner. That was all it would have taken to avoid a great deal of the carnage. So, to recap, certain segments of the market, like the mid-cap segment, are currently most vulnerable to negative sentiments and surprises. So be careful about them. And do not try to dismiss or time the market correction. Being prepared for it could help you take the maximum advantage. Hope you like this video. Stay tuned for more such videos on tackling the market volatility in the coming months. Thanks for watching.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.